Growing up, perhaps you were that kid who could tolerate virtually any risk. But I've got news for you. You're not a kid anymore. Yes, your personal tolerance for risk is, in a way, it's part of your wiring. But when it comes to investing, there is a lot more to it. Because risk tolerance is one of the most important ingredients in creating a plan, especially for retirement, that's right for you. And that's why understanding risk tolerance is the focus of today's show. Specifically, we'll be covering what risk tolerance is and what determines it, and different types of risk tolerance and how they relate to investing for income, the risks of ignoring a risk tolerance. We'll also share some questions to help you gauge your own risk tolerance. And helping me out as usual is income specialist and best-selling author Jeff Small. We're also going to be hearing from our special guest, businessman and financial commentator Jim Rogers. We'll also talk to income specialists James Locke from Delaware and Nathan Cox from Tennessee. And as always, we'll answer your retirement questions. But right now, let's cover some basics of risk tolerance. So in a nutshell, risk tolerance is exactly what it sounds like, an assessment of how much risk you can tolerate. Now, some people, yes, they're naturally wired to take risks. Others are wired to avoid risk as much as possible. And in terms of investing, risk tolerance relates to your ability to withstand losses. If you're investing for growth in the stock market, for example, the question becomes how much market shrinkage can you really handle before you panic or before your quality of life is affected. So knowing your risk tolerance is obviously important in deciding how aggressive or how conservative you want your portfolio to be. To put it simply, if your risk tolerance is high, you'll probably invest more aggressively. If it's low, you'll be more conservative. But unfortunately, like most things, it's not quite that simple. There's two important things to understand about risk tolerance right off the bat. One, it changes over time. And two, your mental wiring is only one determining factor. Why? Because others include your age, your stage of life, right? Because if you're in your 30s or 40s, you might be willing to take more risk than you're naturally comfortable with. However, if you're in your mid-60s, you might take less risk than you instinctively want to. Now, closely related to that is your timeline. If you're 60 and you plan to retire in 5 years, you might want to start getting more conservative now. But if you're 60 and you don't plan to retire until you're in your 70s, you possibly could remain a little bit more aggressive for a while. Now, another factor, obviously, is the size of your nest egg. If you have $4 million saved, you might feel that you can afford to take more risk than someone who has less than $1 million. And finally, of course, your risk tolerance is also determined by your individual retirement goals, something that we'll be talking about coming up in just a moment. But before we welcome Jeff, let me take a moment to answer one of your questions. John from Tennessee asks, is it ever a good idea to start taking Social Security early? I'm 63 and I'm thinking about it. Well, John, sometimes it is, most of the time it's not. So I would say it this way, everything depends upon your personal situation, your personal goals. If you have reason to believe that you, and if you're married, both you and your wife's life expectancies are shorter than normal, then perhaps taking it early might make sense. Also, if you've retired and you don't plan to go back to work, and you really need the income today, then you may be forced in that situation. But for people with average life expectancies or longer, or where one of the spouses have average life expectancies or longer, oftentimes delaying as long as you can is the better answer. So John, thanks so much for your question. Glad to be able to help. If you have a question, email it to me right now at askdave@theretirementinComeStore.com. And now let's bring in the Don Johnson looking, the t-shirt under, I think it's a good look, Jeff, the t-shirt under the sports coat as we approach summertime here in Southern Florida, Jeff Small. Jeff, what do you have to say for yourself there, Mr. Johnson?
Well, Dave, you're the one that's closer to Don Johnson because you're just down the street from Miami. I'm 180 miles north of Miami, so I don't think that's applicable at all.
But you got the look today. I got to hand it to you, and you wear it well. So I'm not complaining. But so let's talk about today's topic: risk tolerance and time frame and age and all those things.
What a great topic for today's show because, Dave, I really feel that volatility is the greatest threat to a happy and stable retirement. And so depending upon the stage of life you're on and your timeline, it's important because the older and closer you are to retirement, the bigger your risk. You can't afford to make losses, so to speak, or have losses.
Yeah, everyone says it's a factor of age, and I say it's not age, it's really timeline, right? Because you could be 65 planning to work for 10 more years, or you could be 55 and plan to retire in 3. So it's really your timeline. But you're right, as the timeline gets shorter, you have less time to recover from losses. And we always talk about that 2000 through 2013 period where the market was underwater for just about 13 years. And if you're going to retire in 10, but you get stuck in that trough, it's not so pretty, is it?
No, it's not so pretty, Dave. And we know at some point the economy is going to normalize. But no matter what the size of your portfolio today is, everyone's dipping their toe in the pool of risk. And so it doesn't matter how much savings you have. Sometimes it's okay to take risk, but sometimes it's not, Dave.
And I said before that if you've got $4 million, maybe you could afford to take more risk than if you have less than $1 million. But I don't want that to be a one size fits all because, if you think about it, as you know, Jeff, sometimes the bigger the nest egg, the bigger the income desire. So if I've got $4 million, but I want to get $150,000 a year from that portfolio, I might have to kick down the risk a notch. Or I could have $500,000, but have a huge pension, and between pensions and Social Security, be bringing in 6 figures, and I might be able to take more risk with that smaller dollar amount. Why? Because I don't need that money to produce income today.
No doubt about that, Dave. But when we look at the traditional income models for folks that need to live off of their portfolio, they've been forced into various new risk categories that they've got to be able to get an interest rate proxy or a dividend yield. So risk tolerance has really become more normalized from that perspective.
Well, and what's happened too, as you know, is we've been able to get people income whether they want to be conservative and in this universe of bonds and bond-like instruments, or they want to be aggressive and they want to be in the stock market. Either way, if you need an income of maybe 4% or so, that means $1 million, somebody needs $40,000 a year, or that $4 million person I spoke of before needs $150,000 a year. They can do it where they want to be conservative and out of the stock market, or they want to be in the stock market. Of course, as you know, the risk of being in the stock market is a little bit greater, simply because they could cut dividends, whereas if you're in the universe of bonds and bond-like instruments, generally they can't. And coming up next, Jeff and I will talk to today's special guest right after a few short comments by yours truly, Jim Rogers. And we'll also break down the different levels of risk tolerance and how they apply to investing for income. All that straight ahead right here on the Income Generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.
Welcome back to the Income Generation. I'm David Scranton, and today our focus is on understanding a risk tolerance. And so far, we've discussed what risk tolerance is, and we've explained some determining factors. But now, let's talk about some different levels of risk tolerance and how they pertain to income. So we've already noted that if your risk tolerance is high, you're likely to invest more aggressively, and therefore you'd be said to have an aggressive risk tolerance. However, as we also said, in addition to your psychology, your age, timeline, goals, and net worth might also put you into that category. And next, there is the moderate risk tolerance level. So that's someone who's willing to take some risk of principal loss, but with a strategy aimed at curbing their risk to a significant degree. And finally, there's the conservative risk tolerance level. If that's you, it means you want as little volatility and as little risk of real loss as possible. As for how all this relates to the income model, let's explain. The conservative and moderate options on the right and in the middle make up what I like to call the universe of non-common stock income generating investment tools. The aggressive options on the left are mostly stock-based and frankly mostly growth-based, but with some income-generating stock opportunities. Together, they illustrate just how diverse and varied an income portfolio can be and how an income specialist can help you create a portfolio geared toward your goals and right for your risk tolerance. Coming up, we'll be talking about some of the dangers of ignoring risk tolerance. But right now, let's get to one of your questions. Kyle from Florida says, I'm worried about the debt that we're piling up with all this COVID relief, and is it going to come back to haunt us? Should I be nervous? Well, Kyle, at some point, yes, although I don't see that happening in the near future, because at the end of the day, most of the Western world is in the same situation. And that means that at this stage, you've heard a term before, but we kind of sort of still are one of the cleaner, dirty shirts in the world's debt hamper, if you will. So Kyle, thanks so much for your question. And of course, I'm happy to answer all your retirement questions. So email me now at askdave@theretirementIncomestore.com. And now let's talk some more with Jeff Small.
So Dave, there's lots of conservative and moderate strategies that you and I offer, but for our viewers and for our listeners that are over 50, you reach a point in your nest egg where you really can't afford to lose anything because your money's got to produce a certain level of earnings or supplementation to your income. And if you had a 30% drop, then you're going to have a 30% drop on that income for the rest of your life. And that's a heck of a lost opportunity, Dave.
Yeah, and and that's the trouble. So that's why when we talk about the conservative part, the moderate part, and the aggressive part, right? The conservative and moderate parts are the ones that, for the most part, most of the things in those two categories have a fixed income stream where the dollar amount, as you know, is fixed. So even if the price drops, it doesn't necessarily have to affect someone's lifestyle. As you also know, Jeff, when you get to the aggressive side of it, there's a conservative end of the aggressive side, and then there's the moderate and aggressive ends of the aggressive side, where frankly most financial advisors live. So, of course, when we talk about higher dividend paying common stocks, we talk about more the conservative end of the aggressive side. But as I said before, even there, as you know, Jeff, those dividends can be cut. And if the market goes down and companies cut dividends, even though they don't do it willy-nilly, it can affect a retiree's lifestyle. But Jeff, I know now is a great time because we need to introduce our first guest, businessman, financial commentator, Jim Rogers, chairman of Rogers Holdings and Beeland Trust Incorporated. Jim, thanks so much for being back here with us on the Income Generation.
I am delighted to be here. I'm very pleased.
Jim, love having you on the show. You know that. Real quickly, though, the Fed has lost their minds. More stimulus than ever in history. So is Congress. More monetary and fiscal stimulus as a combination. A year ago, pre-COVID, the average person with $1,000 in their bank account has 7 times more than that today because of the stimulus. When do we see the stimulus start to normalize out in the economy? Because right now, inflation is going to the moon.
Jeff, it's good to be old in America now because old people are getting the advantage of all of this insanity. But it's bad to be young. My children are going to have a huge burden to pay. This is not good for America. This is not good for anybody, except maybe a few bureaucrats and a few old people.
But Jim, nobody has to pay for that if the rate on that debt is 0%. And they're not even paying principal back. So they've got an open check mentality. But at some point, you're right. The stimulus is unsustainable. Even Jerome Powell said that. So, in your best estimation, when will the economy start to normalize from this massive boost of stimulus we just went through?
Well, right now we're beginning to form some bubbles in the U.S. stock market and the financial markets. The bond market is clearly a bubble. It's never been this expensive in the history of the world. So we're starting to have some bubbles. I would suspect, and my market timing is horrible, I would suspect by the end of this year or next, it will just get too high, and then things will start going down, and we'll have a horrible bear market.
Well, there's no doubt about that. We know that bubble's being created right now, but I don't buy the Fed's argument that inflation is transitory. I mean, for Lord's sake, a container of furniture went from $3,500 to $10,000 in about the last 60 days. Gas is going crazy, so we're seeing rampant inflation across the board. At some point, you think consumer demand would stop because of that, but it's not, because we're living off the stimulus still.
That's because there's so much money being printed and spent and thrown out the window. Jeff, you should go outside and stand out under the window and get some of the money. That's your problem. You're not getting enough of the money.
Jim, that's not the correct answer we're looking for.
Of course, it has to stop. This is going to end very, very badly. We've never had bonds this expensive in the history of the world because the Federal Reserve keeps buying them. We have staggering amounts of debt in the United States, nothing like we've ever had before. Stock markets are starting to form bubbles. I mean, Jeff, you know as well as I know. I mean, I've seen this movie before. I know it ends badly. And unfortunately, it's going to end badly for a lot of people this time around.
Now, one of the traditional models is that, we'll have another, like certain countries, Austria and so on, after World War I, where all of a sudden the currency gets devalued so quickly, you have hyperinflation. But the reality now is virtually every country is now on a fiat currency. Everybody's in the same kind of boat. So, ultimately, how do you see this playing out?
Well, you make a very good point. Everybody's doing it, so all currencies are being debased, which means to me the cheapest asset. Bonds are a bubble, property's becoming a bubble, stocks are becoming a bubble. The cheapest assets are commodities. I mean, silver's down 50% from its all-time high. Sugar's down 70%. Oil is down 50% from its all-time high. Commodities are the cheapest asset class, and normally, as you both know, when inflation comes, the price of goods goes higher, and rice, cotton, gasoline, copper, those are the things that go up.
But, currencies, when a currency gets debased, it's relative to other currencies. But if all the currencies are getting debased at the same time, then isn't it true that nothing's really changed? I mean, a euro to the dollar is the same. The dollar to the yen is still the same because everything's getting debased. So doesn't that play in? Is that part of, or am I sounding like the kids today with modern monetary theory, MMT?
Yeah, more money today, MMT, free money. We all want free money, but this has to come to an end. Yes, all assets are being debased together. Everybody's doing it. Japan, Russia, China, everybody's doing it. Europe, they're all doing it. But unless we now are going to suddenly have a free lunch for everybody, this has to come to an end. At least it always has. It always has in the past. And I would urge anybody who's worried about their retirement or anything else to be aware of what's going on, to watch your show, so they can see what's happening out there.
Well, it's always good to stay informed, and our show is certainly one way to do that. But Jim, of course, I appreciate the plug. As usual, Jim, it's been our pleasure having you here on The Income Generation. And coming up next, I'll point out some of the dangers of ignoring or even of not understanding risk tolerance. And later in the show, we'll talk to income specialist James Locke. All that and more right here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to The Income Generation. I'm David Scranton, and thanks for joining us as we talk about the importance of understanding a risk tolerance. And so far, we've looked at what risk tolerance is, what determines it, and how different levels of risk tolerance relate to investing for income. And now let's highlight some dangers of ignoring it. See, investing without considering risk tolerance is kind of sort of like driving a car blindfolded, right? I mean, odds are you'll eventually regret it. So let's say that you're naturally wired to invest aggressively. Now let's say you keep doing that without considering any of the other factors that help you determine your financial risk tolerance, things we've talked about just a moment ago. Well, in that case, there's a strong chance that by the time you're retired, you'll learn a hard lesson about just how important those other factors really are. On the flip side, let's say you're naturally risk averse. So you follow that instinct and always invest conservatively without considering age, timeline, goals, and so forth. In that case, you could miss out on opportunities to boost your retirement income and to achieve your goals more effectively. But the consequences of not understanding risk tolerance aren't just financial. If your allocation is wrong for your risk tolerance, then in that situation, your retirement could be marred by constant stress. You'll always be worried about money, whether or not your money's at risk, or that perhaps it's not working for you as well as it could be. So here's the good news, is that once you do have a strategy, one with the right risk tolerance, you eliminate that stress. Now, coming up, we'll share a quiz to help you gauge your own risk tolerance. So stick around. And now let's get to another one of your questions. Carol from Wisconsin asks, my husband and I want to set our goals, but we're still giving financial support to our adult children. That makes it complicated. So what can we do? Well, Carol, in that case, I think you need to look at how far out your own retirement truly is. And I hate to say it, but you have to really manage your children's expectations as to how long you can support them and to what extent. Because ultimately, I'm sure one of the things your children don't ever want is have to support mom and dad if they can't really support themselves at the current moment. So at the end of the day, the best favor you could do for your children is putting yourself in a situation where you can maintain your financial independence from the day you retire through the rest of your life. So again, just make it finite, manage your expectations, and get your own goals put together. Bottom line, even if you can't specifically spell out, how close you are, how far you are, what you need to do to get there, at least it's a start. So Carol, thanks for writing in. We really appreciate it. And I hope everything works out. Now, if you have a question, email it to me at askdave@theretirementincomeStore.com. Now, let's welcome back Jeff Small.
Dave, you're so funny. So listen, Dave, since you and I have been doing this for over 35 years now, you and I have lived through a dichotomy of investor mood swings that seem to be correlated to when the market gets more riskier and everybody wants to get out, and also when the market's going up and everybody wants to make money, but everybody wants more money. So less isn't more when it comes to money, more is more. And so you got to be patient about the market, right?
You do. And what you described is just the cancer that occurs, unfortunately, in most investors' mind, is that, instead of doing what a lot of well-known market experts have done in the past or said in the past, that they want to invest in the markets when they want to buy when blood is in the streets, when everyone else is selling, which means that when things are really low, you've got to be willing to jump in and buy. But unfortunately, that's when a lot of people are wired to be nervous, to sell, to panic, etc. But then only when things have run up a significant amount have people's confidence grown to a point oftentimes where they want to jump in. And sure, they can run up further, but that could also be at the point where you might just possibly be buying at the peak. And that's where when somebody with a real conservative risk tolerance level tries to be aggressive, if they don't have the right financial coach, they can get themselves in trouble.
Well, there's no doubt about that. However, Dave, when we look at the markets, you've got to gauge your money to what stage of the market cycle we're at and where your needs are, not where your subconscious mind is telling you, I need more, because chances are that's not going to really help you in your retirement.
Yeah, and it's think of it this way. If you walked in a casino and there was a game there that said, hey, if you win $10. If you lose $20 or $30. Well, Jeff, I know you're not going to be playing that game. Well, that example, you're not a gambler, you don't go to the casino anyway. But even if you were, you're not going to be playing that game. and neither would most of those that are joining us today on this show. So to really play that game, and even if you were a gambler, to do it intelligently, you'd want to have more upside than downside. We'd want to go in and say, okay, I'm going to spend $10, but I've got the ability to win 20 or 30 or 50. And in fact, Jeff, that means it's time to bring in our next guest, someone who understands the importance of risk tolerance, income specialist, James Locke. He's the founder of Pool Locke Associates, located in Wilmington, Delaware. James, it's great to have you back with us here on the Income Generation.
Hey guys, so glad to be back.
So James, in your experience, do most people fully understand the concept of risk tolerance as it relates to investing?
Most people that we run into have very little understanding of risk tolerance. They have been investing and saving all their life and really just been keeping their head down. And now all of a sudden they're getting closer to retirement and some advisor is telling them, hey, you're okay, but they've never really done a deep dive and taken a look at it. And when we start talking with them, that all changes.
Not surprised by that at all. However, as an advisor that you are, James, how important is risk tolerance in helping you build the right strategies for a particular client's need?
Every client is different. So you have to start with that understanding that, everyone is different, but risk tolerance is really that cornerstone. Where are we starting from? If somebody comes in and says, hey, James, the most important thing to me is I don't lose a penny. Well, then we know where we're starting. And other people might be further up the risk scale, and analyzing that starting point is critical to know where you go from there and what's going to work for that particular client in their entire investment retirement portfolio.
And so I bet you it's more common than you probably realize that people unknowingly don't know what their risk tolerance is, and they might be overexposed to risk and not really know it.
Absolutely. A lot of people that come in and we talk to for the first time, their experience previously of understanding risk was probably filling out some form and they got a letter assigned to them, A, B, C, D, or E, or some number, and it doesn't really mean anything to them because they just think, oh, well, I'm not so risky, or I'm in safe stuff, and they can't really define it. We see that all the time. Once we really get in and break down where their true risk is, and hey, what will happen to you if the market starts lagging, starts going sideways, or even starts going up, what's going to happen to you in your portfolio, and does it make sense for you in your retirement?
And James, you and I love those canned risk tolerance questionnaires, equally, right? That they're there for one purpose, and that is to cover the rear end of the existing advisor, is it not?
Yeah, absolutely. In these larger, kind of chop shop organizations, the upper management, they can't trust the kind of day-to-day operation person. So they say, hey, we're going to help you by giving you this outline and just do what we say. And then a lot of advisors just kind of follow that leadership. And, it's not always the best case for the individual client. They're kind of getting cookie cuttered.
And firms make more money in most cases when they can manage risky assets. They could charge higher fees, higher commissions. So most of those questionnaires end up pushing up a notch or two from where you really should be. Bottom line, out of every 10 people that first come to see you, how many of those 10 have an allocation that's right for their risk tolerance? What do you say? What number comes to mind right away?
I would say 15% at best have a risk tolerance that matches where they're supposed to be.
Which means, James, that 85% are people that you can help and put them in with a strategy that matches their risk tolerance level. So if you're anywhere near the Delaware area, give James Locke a call, founder of Pool Locke and Associates in Wilmington. James, thanks so much for being back with us on the Income Generation.
Hey guys, thanks so much for having me.
Okay, now it's time to get your pencils ready. Why? Because coming up next, we're going to have a little quiz to help you determine your own risk tolerance level and whether or not your financial strategy suits it. Plus, we'll talk to income specialist Nathan Cox from Tennessee. all that ahead right here on the Income Generation. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit. Chock full of information you need to know to get steady income during your retirement. Call 866-314-7227. Online at theretirementincomestore.com.
Welcome back to the Income Generation. I'm David Scranton, and it's great to have you. We're talking about understanding risk tolerance, and so far we've covered a lot, including what risk tolerance is, how it's measured, different types of risk tolerance, and some risks of ignoring or not understanding risk tolerance and its importance. Now, here are a few questions to help you determine your own risk tolerance level. Question 1. Which best describes your natural attitude toward risk? A, you enjoy taking risks. B, you don't enjoy risk but are willing to take some. Or C, you avoid risk as much as possible. Okay? All right, A, B, or C. Question number 2. What life stage are you in? A, the growth and accumulation stage, your 30s and 40s. B, the income stage, meaning your early 60s or older, where you'll need retirement income now or in the near future. Or C, the transitional stage, meaning your 50s to early 60s, where you need your assets to start generating income in the next decade or so. You ready? Okay, here we go. Question number 3. How confident are you that you've saved enough or will have saved enough for retirement? A, very confident. B, fairly confident. Or C, not confident at all. Ready? Now to our final question, number 4. Which statement best describes your retirement goals? A, I want to make a major purchase early in retirement. B, I want to leave a large legacy for my children. Or C, I want to live comfortably and do the things that I enjoy without worrying about running out of income. Okay, pencils down. Now, to help determine your risk tolerance, look at your answers and see how they balance out. For instance, let's say you answered A, C, B, C. You like taking risks, you're in the transitional stage, you're fairly confident in your savings, and your goals are income-based. Well, if you're currently investing at the aggressive risk tolerance level, now might just be the right time for you to switch to the moderate level. See, in the universe of income-generating options, that could mean shifting from your current growth stock strategy to one focused on high dividend yielding value stocks. And that's just one possibility. But the important thing is that you'll now have a strategy that's truly right for your current risk tolerance with all of the relevant issues factored in. Now let's take one more question from you. Amy from Iowa says, we're retired, we're pretty comfortable, and my husband wants to start investing heavily in gold. Is that a smart move? Well, heavily depends what you mean by heavily, because when it comes to investing in gold, gold does not generate income. So even if you don't need income today from your investments and you're comfortable, income is still is something that most retirees invest for, because income helps you lower your risk. And if you're investing for dividends in the stock market, it also can help you increase your return by dollar cost averaging, something we've talked about a lot right here on this show. And gold doesn't really generate any income. It's purely speculative, and therefore you need to be careful on how much you invest in. So a general rule is making sure it's less than 5% as an absolute maximum of your overall invested portfolio. In theory, as an inflation hedge, although as you probably heard me say on the show before, I'm not even sure gold is really a great inflation hedge anymore, since we've been off the gold standard now for virtually 5 decades. So Amy, great question. Thank you. And be sure to send me your questions anytime by emailing askdave@theretirementincomestore.com. And now let's bring back in Jeff.
So anyway, Dave, most investors have an inner voice And when you get within 5 years of retirement, that inner voice is going off saying, do I want to have this much exposure to risk at this stage? And so is it time to reassess my own risk tolerance as a pre-retiree? And so I've heard that more often than not from so many folks over the years, especially when they realize it is time to transition and reassess, Dave, their risk tolerance, that is.
You know, that's that transition stage. And for the person who has that inner voice, well, God bless that person. Listen to that inner voice. But for someone who's within 10 years of retirement and doesn't have that inner voice because you're so aggressively wired, that's when you really need to bring in a coach being a true income specialist who can be that voice of reason, if you will, and maybe talk you down from aggressive to maybe moderate. Just like oftentimes in football, a defensive coordinator might do to help out a head coach or an offensive coordinator.
Sure, and that coach, Dave, could be the right financial advisor that's going to design a strategy that might be more important than having a specific lump sum of money, but more of an income stream off of their portfolio. And so most investors out there should go out there and find 3 or 4 financial advisor, fiduciary types to help them reassess what they can accomplish in retirement and creating income versus transitioning their risk tolerance to maybe something that suits them based on their lifestyles.
Yeah, and that strategy that Jeff is talking about right now is the strategy is that the one question on that quiz that said, hey, what's your big goal when you retire? To make a major purchase, to leave a big legacy, or to really just live a comfortable retirement and have enough income? Because most people come up with answer C, letter C. They just want to have enough income to reach their retirement goals and know they're not going to outlive income. Because at the end of the day, everyone wants maximum return with minimum risk when it comes to their investments. But they've got to say maximum return for what ultimate goal? And I guess, Jeff, that brings us right now to the introduction of our final guest, someone who's very good in helping his clients determine their own goals and therefore their own risk tolerance level, Nathan Cox. He's co-founder of Retirement Income Solutions, a retirement income store located just outside of Nashville. Nathan, thanks so much for being back with us here on The Income Generation.
Well, thank you. Thank you for having me.
So Nathan, one thing I often find is that people don't realize the importance and magnitude of what certain risks are that they're usually taking. And it might be because of their current advisor, or maybe they don't understand and have all the relevant facts. But do you ever run into this?
Oh, absolutely. Yeah, I think the financial services industry as a whole does a pretty poor job of explaining risk tolerance levels. And I think a lot of people really don't understand truly what type of risk that what risk they have in their portfolios.
So what do you think then the most important thing is you think people should know about understanding risk tolerance?
The most important thing, okay. I think that the most important thing for people to realize is that everyone is very unique. Everyone has their own unique fact patterns when it comes to risk tolerance levels. You know, what your coworker, the amount of risk your coworker has in their portfolio, or maybe a friend or family member, really doesn't have that much bearing on your risk tolerance level. I think people need to understand that they're unique. They have different unique fact patterns, and their risk tolerance levels may be completely different than others that they know.
Sure. So what you're saying then is your risk tolerance will be adjusted and or change as you get older, or maybe closer to retirement.
Oh, absolutely. Yeah. And it depends on many other factors, such as, how much income you need in retirement, and where your income sources, where's that income going to come from?
You know, Nathan, it's funny. We had James Locke on, whom you know, just a while ago, and I asked him this question. I've got to ask you the same question. When someone first comes to you, out of every 10 people, how many of them would you say come into your office when they first meet you with an allocation that actually matches their risk tolerance level?
Very rarely. I think I find more often than not that people come in and they really don't understand. I really firmly believe that people understand that they're taking some level of risk for the most part, but they don't really understand what risk level they're actually in. Because they really don't know what they have, in a lot of cases.
So are most people too conservative relative to their risk tolerance level, or are most people too aggressive, taking too much risk, and maybe they don't realize it?
I think most people are too aggressive and they don't realize it, but it seems to be the two extremes. A lot of people they tend to go to extremes. They're either, way too conservative. The number of people that are in that bucket are usually a lot fewer, but most people are taking way more risks than they actually know that they're taking.
Or you get the other ones, which are my personal favorite, who are half and half, right? They have half their portfolio in risky growth stocks, half their portfolio is sitting in bank CDs. And it's almost as if there's two buckets of water here. One's boiling hot, one's ice cold. You put your one foot in one, the other foot in the other, and it's almost like they're trying to convince themselves they're okay. And as you know, as someone who I consider to be an expert at determining risk tolerance and appropriate allocation, it just doesn't work that way. So Nathan, thanks so much for being back with us here on The Income Generation.
Thank you for having me.
And thanks to all of our guests, and especially to Don Johnson, AKA Jeff Small. We've had a great time today, and thank you especially for joining me once again right here on The Income Generation. Bottom line is, if you're close to or you're in retirement and you're concerned about your money, it's essential that you stay informed and up to date. And as you know, right here is where you could do it on The Income Generation. I'm David Scranton, and we'll see you next week.